Welcome to yet another edition of Simplified. It's been an extremely interesting day. India's Reserve Bank, the central bank, came out with a major policy decision, a major monetary policy decision that was not expected at this time. Usually the Reserve Bank of India has a scheduled line of meetings where the Monetary Policy Committee meets and decides on what it's going to be doing in the next few months in terms of controlling inflation or letting inflation go, but boosting the economy. What should be the central bank's policy? Yet 1 month after they did so, and much before the next meeting was supposed to happen, in a sudden shocking move, the Reserve Bank of India today announced that they are going to increase key interest rate points that we usually refer to. These are very complicated terms, repo rate and cash reserve ratio, but essentially two important tools that the RBI actually uses when it needs to battle inflation. And not only did they change these two, they also changed it by a big number. So 50 basis points change in the CRR, the cash reserve ratio, and 40 basis points for the repo rate. That's a very big chunk to do in one go, especially when you haven't really changed your key interest rates in almost a year. The last change actually was in May 2020. So yes, while experts will say that this was coming, it was expected across the world, we are seeing the same trend. As prices go up, inflation becomes a big concern. Central banks across the world are now looking at a change in policy. But let's try and understand what changed just in the last 1 month. And why is it that the Reserve Bank had to do so right now? What does this really mean? What does it mean for you and me? How much will our EMI or interest on our home loan, car loan, personal loan really go up? And is this just the beginning? Is more coming? And to make sense of all of this, we've got Mr. Shankkar Aiyar, political economic analyst and author, joining us on this conversation. Good evening, Mr. Aiyar. Good to have you with us. The Reserve Bank of India and the governor today in his news briefing gave a series of reasons as to what's really changed since the last time they came and spoke to us almost a month ago. Rising inflation, geopolitical tensions that continue, primarily of course the Russia-Ukraine war, high crude prices, global shortage of commodities were some of the key words that he repeatedly used as he built the base to make this announcement. Help us understand, why was this decision taken out of cycle, as it's said?
But there are two ways to look at it. Now, there will be those who say this is a smart move to restore the credibility of the RBI. Some would say that this is like Ravichandran Ashwin sort of hanging up his bat in the middle of the match to let a big hitter come into the match. You could also look at it as the two tomatoes crossing the road and one of them gets crushed. Essentially, everything that the governor said today, he also said in his April statement, which means all the conditions that he spoke about were visible in April. So as they say in Hindi, Jab jago tab savera. So suddenly the RBI recognized that it had missed the bus in February. It had missed the bus in March. Now, what do I mean by when I say that it had missed the bus? The RBI is mandated to keep inflation under 6%. It's a broad range between 4 and 6%. So in times of crisis, they allow it to go. So for 3 months, consumer price inflation had been 6+%, which means that they had to increase the rates in February itself because the trend was visible. Now in finance, they say the trend is your friend and latch on to it. But the RBI didn't do that. It had some very vague reasons in February to not increase rates. In April, it spoke about all the reasons why rates should be increased. It increased its own target for the year for inflation. It decreased the GDP rate for the year. It spoke of all the conditions, the invasion of Ukraine, supply chain, all the issues. So why didn't it do it then in April? That's the inexplicable part. And now, because the US Federal Reserve is going to raise rates. All the central banks are going to raise rates. It has suddenly jumped into the queue. So effectively in April, when the Reserve Bank was asked, would you be raising rates? It said yes, no, maybe, and it sort of reflected the confusion in their mind. And now they have raised by 40 basis points, because when you don't take the medicine in the first course, then you get a double dose. As far as the CRR is concerned, which is 50 basis points, that is okay because these banks are sitting on cash, credit growth hasn't been sort of galloping away, so they can do this much. The fact is that inflation looks very entrenched and the RBI is clearly behind the curve. Now, when I say behind the curve, what do I mean? That tonight as we speak, Wednesday night in US, the Federal Reserve will increase rates by about 50 basis points. It is expected that it will raise every month 50 basis points. So what's the RBI going to do next month? That's the question. So the reason why the RBI jumped up today, sort of 9 hours before the US Federal Reserve, is a sort of admission that it has been behind the curve. It is also a fear that already, in April, about 29,000 crores of foreign portfolio investment money went out. The fear is that if they didn't act and protect the interest rate differential between the US interest rates and the Indian interest rates, the rupee will get hit. And that's why they acted post haste today.
Right.
Will that be enough? We don't know.
Right. No, like you said, the US Fed is likely to start increasing interest rates or hiking interest rates from tonight and every month from here on. Back home, many were bracing that when in June the Monetary Policy Committee meets, they are going to also start increasing rates, which some thought was also RBI, maybe rushing it. But now, obviously, it's happened right away and maybe another round next. Which brings me to the next question, which is to say, as from a consumer's point of view, from a borrower's point of view, are we staring at a situation where we will see more interest rate hikes? And I ask this question because a lot of people will be wondering whether they should just seal in their personal loan or car loan right away, or if this is it, nothing more is coming, so they still have some time before they rush in.
So they should expect that interest rates will go up. Savings and deposit rates may also go up, but not as much as the interest rates that borrowers cost. The differential between global rates and Indian rates is determined by the level of inflation we have here. It determines the currency rate. So it's a complex triangulation that central banks work with. I suspect in the next 1 year or towards the end of the year, interest rates would have gone up by a full percentage point, which would translate to many of the homeowners a higher rate for their home loans if they're on flexible or floating rates. If they have been on fixed rates, good for them. It will also increase cost of student loans. It will increase cost of automobile loans. It will also increase cost in general costs of living, because money fuels the economy and there will be a cost to it. What will happen is that already you have an inflation for food and fuel prices. Now there's a cost of money will add to it. And this could hurt consumption at some level. It will affect GDP growth. So we have to brace ourselves. I wrote a couple of weeks back, tighten your seatbelts and sort of get ready for a rough ride.
Yes, you did. In fact, you also did question why the RBI did not move forward last time and gave us very, very confusing signals, and that's why they're having to do so now. But let me also take a step back and talk about the scenario. I mean, without getting caught up in the jargon and specifically looking at why this is happening. Because, Mr. Aiyar, we're looking at a massive surge in prices for all kinds of things that we're using in our daily lives. We here on Simplified also did a conversation about the the problems around inflation and why it's happening in our country. Our consumer price index and the wholesale price index both are at current extremely high levels right now, and that's obviously something that the Reserve Bank of India looks at. Now, if we are to then interpret what the Reserve Bank of India governor is telling us today, what the worldwide big leaders are telling us today, what does it mean? Can I say that for the next few months at least, I'm going to still be paying a lot more for my food, a lot more for my fuel, and we don't know for how long?
At least till the end of this calendar year, you would be paying much more for borrowing. You would be paying more for fuel, because if you see, crude oil prices since February have not, in fact, since January have been sustained at $100 per barrel, which means fuel prices will be up. Now, fuel runs the economy, so transport costs, logistics costs go up, so there will be that. One of the things that people need to understand is during the COVID pandemic, Western nations, US particularly, created a lot of money, which is what they call it, which is printed money, to sustain their economies. Now, there is no such thing as a free lunch, and the cost has come to roost across the world. The second part is that China, which was the only economy in the world which didn't contract in 2020, the COVID year, is threatening to go into some kind of slowdown contraction because of the cases in Shanghai and Beijing. Now, what happens in China matters to the rest of the world, because China supplies roughly $3 trillion worth of exports to the world, and that affects the supply chain. Now, when you don't get something, the price of it goes up. So the Western world's first created money and thereby created inflation because when you create something artificially, its value goes down. The Chinese economy is suffering from its lockdowns, rolling lockdowns for over 4 months. And add to that the Ukraine war. Now, Ukraine and Russia are two major producers of minerals. Ukraine supplies a huge quantity of wheat and sunflower oil to the world. So those prices have gone up. Now, because sunflower output is down and supply is down, Indonesia went and banned the export of palm oil, which is one major consumption thing for India. So now all these things start playing with each other. And one of the primary reasons that there has been a rise in prices of commodities is also because money was cheap. So punters were investing in some of these commodities. Whether the increase in interest rates will bring that down depends on how much profit they expect on the other end. So we are going to be in this uncertain phase for 6 to 8 months. I mean, the world has always been an uncertain place, but what we are looking at now, even the familiar is now uncertain. So we are in for a rough time.
Yes, in fact, let me just read out from the governor's statement today, in which he also refers to what he said in April, where itself he had said that, there are humongous challenges that we are facing already, tectonic waves hitting Europe and rest of the world, and still at that point, the Reserve Bank of India did not go ahead with a big move. But this time they have. And they say, as we navigate through this difficult period, this is what Mr. Shaktikanta Das said, it is necessary to be sensitive to the new realities and incorporate them into our thinking. In its World Economic Outlook of April 2022, the International Monetary Fund has noted that the economic effects of the war are spreading far and wide, like seismic waves that emanate from the epicenter of an earthquake, mainly through commodity markets, trade, and financial linkages. This to me sounds an extremely, the wording itself is so concerning and slightly disturbing as well about the dark times that we are staring at least for this year, Mr. Aiyar. Again, I will ask you to help us simplify this for our consumers, borrowers or otherwise. What does it mean for us? Okay, Reserve Bank of India came out and increased the repo rate by 40 basis points. Okay, they may do it again next month, but how does it change my life?
So roughly in the last 2 years, people who would have borrowed for a home loan would have borrowed at a roughly around 6 to 7% maximum. I think 6.5, 7%. So their borrowing cost, depending on per lakh mathematics is, the borrowing cost will go up by about a percentage. So you will have, if you are on floating rate, you will have a higher outgo of EMI, or your period of loan will get extended depending on who you borrowed from. Student loans are not that fortunate. There's no extension allowed. I mean, most of the student loans are fixed term, and people who have sent their children abroad and have taken maybe 16, 20, 30 lakh loans, their rates could also get affected depending on how they negotiate. Automobile sales, if you remember, two-wheeler and four-wheeler sales have been hit. So this will impact them further. The fact is that if you look at the wholesale price index, it has been in double digits for a full year. Now, Governor Das has mentioned several reasons, and at least 6 or 7 times in his statement, he said, as we said in April, but we did. What he didn't say was that, but we didn't do anything in April. So when you look at the composition of the inflation, it is fuel, it is food, and it is general inflation. In fact, the chairman of Hindustan Lever or Unilever said that rural demand has fallen. If you ask two-wheeler producers, their demand has fallen. All of this has a cascading effect. If companies are unable to sell their whole output, are falling short in sales, it will affect the economy in its employment. It will affect people's incomes. There are indirect employment that will get affected. The construction sector, real estate had just picked up. Now, what happens to demand is a question. So for the general person, what we call John Jani Dhanardan, this is going to be a tough period because they will have to live with high inflation and high interest rates.
Okay. My last question to you before I take up and try and summarize what we've spoken here. I know before you joined us, you were part of a conversation which was about the government and India's original target of becoming a 5 trillion economy by 2025. With the kind of uncertain times we're looking at this year, with the pandemic, and then now these fresher global challenges, what is your view? What happens to our economy then, which Governor Das himself says that it is beginning to show some strong signs, at least in the urban areas?
So there are several forecasts of how fast we will grow or how rapidly we'll grow in the next 12 months. And the IMF has a figure, the RBI has a figure, the economy, but all of them will consistently now in the next 6 months downgrade the forecast. My own estimate is it will be less than 7%, maybe around 6.5%, given what's happening. So there are reasons for it. One is that exports will shrink as global demand falls. China is affected, at least 1 quarter, its slowdown and contraction, depending on how Chinese government sort of reveals its data, you will know whether it's a contraction for a quarter or more or what. Europe is in a far more difficult place because of the war, and also because their stimulus package is embedded as subsidies to people which cannot be taken away. So they are definitely going in for a recession or a contraction towards the end of the year. The US, because it will rapidly increase interest rates, will again struggle next year. Now, with all this, India's exports are dependent on what the world wants, so it will slow down. India's own consumption will depend on jobs and income, so it will slow. So coming back to the $5 trillion target, I think it will be affected by the global factors. It will also be affected by how nimble and humble policymakers are. I mean, the Reserve Bank of India clearly messed up in Feb and April. Hopefully, they won't do so again, and hopefully, there will be some step. Mind you, there are opportunities in the crisis, in the invasion of Ukraine. We will get some cheaper, probably Russian oil, but we might also open up new places to export. Companies which are tired of the China situation might sort of opt to produce in India. So those are all opportunities.
Yes.
But it all depends on how the government responds to the opportunities.
Yes. Oh yes, absolutely. Could not have agreed with you more. Thank you so much, Mr. Aiyar, for joining us and helping our viewers understand, decoding this and sharing your insights. And as I let you go, I just want to quickly get back to the basics here, and which is what we always try to do on Simplified. Not only do we get you the expert views and arm you with all the information you need to form your own opinion, we also break down the technical jargon for you. So today, I'm going to reiterate what repo rate means. The entire conversation really was about a hike of 40 basis points to 4.4% repo rate. Now, what is repo rate? And it's on your screens right now. It is a rate at which the central bank of any country, Reserve Bank of India in our case, actually lends funds to commercial banks. Now, commercial banks, when they run out of funds, they turn towards the RBI and they take the funds from the RBI, and they are supposed to pay back at this rate. This repo rate really decides. So, essentially, RBI uses this as a tool to control how much money is out there in the market. And as you control that money in the market, it becomes a tool to then control inflation as well. So if you suck the money out by increasing your repo rate, then there will be lesser money in the market, and that will lead to lesser inflation. If you actually lower your interest rates, then there is more money in the market, more people will be borrowing it. That helps the economy, but it also may lead to a runaway situation as far as prices are concerned. So repo rate then becomes a very important tool for the central bank of any country to battle inflation, which is one of the most important functions that a central bank has. Now, keeping that in mind and the decision that has been taken by the Reserve Bank of India, what is going to be the impact for you right away in the short term? Well, the rates on all loans are likely to go up 0.5% at least, if not more. So that's what you should right away be watching out for. Loans will become more expensive in simpler terms. EMIs will become, your entire burden will go higher. Of course, now if the EMIs and the loan interest rates are going higher, that also means that your saving interest rates will also possibly improve, though may not be with the same proportion. So you may end up paying more than what you get on your savings. If you are planning a car loan or a personal loan where usually your interest rate is fixed, you might as well act now and get your loan now before today's action translates into a higher interest rate that any bank gives you. But of course, for most of the home loans, as we know, and all home loan borrowers will know this, the interest rate also changes. It's a floating interest rate. So timing really isn't crucial there. You will just have to brace yourself for paying a higher interest and having a bigger EMI. Short-term deposit rates will of course increase as well. So these are largely what you can expect basis what the Reserve Bank of India has done on a direct basis. There's a larger economic impact that we just discussed with an expert, and that we will continue to see how it really pans out in the next several months as Reserve Bank of India tracks the situation, takes decision, the government takes several decisions, and the global situation changes when it comes to prices, crude prices, commodity prices, food prices, and of course an ongoing war which is currently taking place between Russia and Ukraine. Hope that was helpful. Thank you so much for joining us on Simplified.